Silicon Valley may have its own reckoning in the wake of the banking crisis sparked by SVB. A major VC executive warning his industry is entering a multi-year correction. Chuckie Reddy is a partner at QED Investments. It's an early-stage VC fintech firm known for its involvement in Credit Karma. Chuckie, great to have you with us.
Great to be here.
It seems like there's a 1-2 punch that's going to hit VC. Not only are rates rising, but we also have this banking crisis affecting lending, credit crunch coming.
Yeah, I mean, VCs for the first time in 20 plus years is actually going to correct. It's one of the few industries that didn't go through a correction in 2008. And so since the tech bubble burst 22 years ago was the last time there was a meaningful correction around venture capital. And it was more of a cottage industry at that point. There had been a little bit of growth in tech, but it didn't really go all the way around. And now we're starting to see that unlimited capital going into the market, people being hired through all these companies and all these VC firms, tons of VC firms being around. We're about to go through that 2 or 3 year cycle where we're probably going to have a correction.
So, Chuckie, talk to us a little bit. There was a lot of capital raised in 2021 before the public market started correcting, right? And so it's kind of sitting there. I talked to a lot of VCs like yourself there. You have capital to deploy. Are we going to start seeing more deals, but just at kind of lower valuation levels? Because where you guys play, this is just a secular trend that's going to be going on in fintech for decades now. And I'm sure you're still seeing opportunities, probably at much better valuations than maybe a year ago.
We are starting to see better opportunities, but the opportunities we're seeing are maybe not as high quality. And so I think that's one of the reasons people aren't putting money to work. The other thing is I think people think they're going to be able to buy it for cheaper tomorrow. So we're in this deflationary period where we haven't hit the bottom yet. We thought there'd be a wall that would come of maturities and all of a sudden tons of deal activity would happen, but we still haven't seen that.
One thing after Silicon Valley Bank had its demise, everyone started saying next shoe to drop. And you hear a lot about commercial real estate. You also hear a lot about non-bank financial institutions, which includes asset managers, insurance, hedge funds, and private asset managers. The call is for more data, more regulation. What are you hearing? What do you think is coming down the pipe in terms of more government oversight for your industry?
For venture capital, it doesn't seem as though there's probably that much oversight coming per se. But I think when it comes to banking, we have probably seen, such a small event happen in a relative sense. So the regulations actually generally worked, with the exception of one change that was made with respect to the size of what institution would become a systemically important financial institution and be governed a different way. So I don't see that much regulation coming from what we've seen thus far. But if things continue to get worse is when you'll start to see the regulatory folks pick up their head.
Will we see a wave of bankruptcy among early stage firms at this point? I mean, there's a point where you say we're not going to put more money into this firm because our framework is going to be different in this environment in terms of investing.
Yeah, absolutely. I mean, I think we had 3 years in our portfolio without 1-0, wow. Which is pretty crazy for an early stage fintech firm. We are starting to see the failures happen, but they're relatively slow because of what Dan talked about. Right. A lot of people put so much money and overcapitalize these companies, and they'll run until there's literally $1 left in the bank. And so they're not going to fold tent if they have $1 million left. They're going to continue to operate and punch like they're going to get out of it.
But I would think that time frame is shortened if there's a recession.
Yes, absolutely. Your top line starts to shrink very quickly, and then your burn goes up, and that's game over.
All right, Chuckie, thanks so much for coming by. Great to have you with us. We'll see you again soon.
Absolutely.
Chuckie
Thanks so
Reddy,
much.
QED. That sounds kind of scary.
Well, it's a fascinating time, although I'm sure there are many in the VC world that say that they welcome the shaking out of this. I mean, things have gotten really fluffy. It's also an interesting dynamic because there are a lot, especially in the private equity world, there are a lot of funding obligations for bad companies. And private equity companies have to make some really difficult decisions. Are they going to keep throwing money down the hole on a company that they've been supporting for the last 2 years of not making money? And we see this, and I see this in a lot of different industries. I've seen this in the cannabis industry. Like you see private equity guys that are at some point, like they're hemorrhaging too because they're forced. At some point, this is very good for the public markets. Okay, I mean, if you think about both scarcity value and if you think about just at least the quality factor of those companies that are here, that are growth companies and need to be given the right multiple. Right now, they're not being given that. But I think this bodes, whenever that is, this is good for publics.
Yeah, you made a great question. The question you had about are we going to start seeing companies go out of business? Before SVB, there was calls for mass extinction events of really poorly capitalized, bad valuations. And so you got to think that that's going to start to accelerate. Your other point is they can only cut so much before they just kind of have to shut the doors.